Booking Holdings is the world's largest online travel aggregator. They rank first in traditional accommodations such as hotels and motels, and they rank a close second in the alternative accommodations market where Airbnb is the leader. They own several properties that I'm sure you've all heard of and probably use regularly, such as Booking.com, Priceline.com, Kayak, and OpenTable. They make money by charging a commission in the form of a percentage of the total bill, and they also generate advertising revenue by displaying ads on their sites and charging a fee per impression and or click. On average, they take a 15% cut of the orders that pass through all their properties. They facilitated $165 billion in orders in 2024 and reported $25 billion in revenue. For reference, the credit card companies take 3 to 5%, while Uber takes 27%. So 15% is good, but it's not great. They have a strong moat underpinned primarily by a network effect and intangible data assets, and to a much lesser extent, switching costs and barriers to entry in the more fragmented markets. I wouldn't call their moat world-class though. They're not on the level of the greats like Visa, Microsoft, and Salesforce, which really have their customers by the cojones. Their strategy is centered around what they refer to as the connected trip, which is just a fancy way of saying a full itinerary. Not only do they offer a place to stay, they also offer flights to get there, rental cars while you are there, as well as in-trip activities like tours, restaurants, and a range of other add-ons. Their mission is to be the one-stop shop for all your travel needs. One app to go to get everything you need for your trip. This convenience and their breadth of offerings is what solidifies their network effect. In fact, their app is the top travel app in the Apple Store, and the visits to their sites blows the competition out of the water. In 2024, they logged 362 million visits to their sites versus less than 100 million for Airbnb, which is the next closest competitor. And what's intriguing is that they have room for improvement in this area of their business. Direct visits to their websites make up approximately 50% of total visits, which is right around the average for the industry. If they can increase to even just the low 60% like Airbnb generates, it will result in margin expansion because they'll be able to reduce their marketing and advertising costs while generating the same revenue. Layer on the adoption of their rewards program, and a synergy is created, resulting in a strong network effect and customer data that they can use to better serve and advertise to their customers. All of this has led to and is expected to continue to lead to higher room night growth and conversion rates. Two recent examples of their network effect in action came when they started offering flights, and more recently, their offering of merchant payment services. Booking's quarterly air transactions ramped from a roughly stagnant 2 million between 2014 and 2020 to about 4 million in 2021, 6 million in 2022, 9 million in 2023, and 14 million in 2024. Additionally, merchant payment services have been met with rapid adoption. Both of these are concrete examples of Booking's increase in the supply of offerings on their network, and those actions being met with very strong demand, which is the telltale sign of a network effect. Their competitive advantage is further enhanced by switching costs and barriers to entry in certain markets. Switching costs are present only on the merchant side. It literally costs travelers nothing to switch to a competitor, which is one of the weaknesses in Booking's network effect. Having said that, one of, if not the, largest expenses of travel companies is advertising and marketing. In order to generate sales in the travel industry, it's imperative that potential travelers are constantly reminded of who you are, what you offer, how to get your app, and your prices. This is where Booking comes in. They have a massive marketing budget consuming 30% of sales, or $7 billion per year, to help drive travelers to their app where they can see hundreds of thousands of offerings across the world. This helps their merchant customers by essentially marketing and advertising for them. By being part of Booking's network, merchants don't have to spend nearly as much on advertising and marketing as they would if they had tried to do it themselves. Not to mention that they are likely to be much less effective at converting sales than Booking is, which means a higher ROI than they would otherwise be able to generate. It's a win-win for both Booking and the merchant, and this helps lock those merchants in, because if they were to leave, they'd see their marketing costs increase and the conversion rates decrease, resulting in lower sales and profits. Their offering of payment services also helps lock merchants in through the same cost-saving mechanism. Because of the volume that crosses Booking's network, they are able to negotiate better terms with the credit card companies than any individual travel agency. Because of this, Booking can offer payment services more cheaply to their merchants than those merchants can get on their own. This reduces their costs and helps lock them in. And finally, they benefit from barriers to entry due to the fragmented nature of accommodations in some of their international markets. There's a much higher percentage of independent independent or mom-and-pop hotels in places like France, Italy, and many Asian countries. This fragmentation makes it more time-consuming and expensive to negotiate agreements with these independent providers, raising the costs and time it takes for any would-be new entrants to replicate Booking's breadth of offerings in those markets. Now that we're grounded on what the company does, how it makes money, and its competitive advantages, let's dive into their financials. They're growing revenues at around 10% over the past 5 to 10 years, but that's expected to slow to 7 to 8%. They have really good geographical revenue distribution, and their cash flows have been growing at slightly higher rates. They're highly profitable with free cash flow margins around 30%. Return on capital baseline is in that 25 to 30% range, but has been up in the 40 to 50% range the last couple of years. I fully expect that to come back down into the 25-30% in the future. Operating margins come in the high 20s to low 30% range, and what you'll notice is this gradual decrease in their operating margins over the past 10 years. This is the result of their entry into the alternative accommodations market to compete with Airbnb. These properties are much more fragmented than the traditional accommodation market and therefore costs more to negotiate and aggregate, resulting in lower margins. As that market grows as a percentage of their total sales, we will see downward pressure on their margins. But I'm not worried about this because one, it's well known by the market and is therefore already priced into the stock, and two, they're undergoing several efficiency enhancing initiatives that should lower costs and help offset some of this margin pressure. They also pay a small dividend, which they just bumped up by 10% this year, which is a great start, and their ample free cash flow bodes well for similar increases in the future for all you dividend growth investors out there. And lastly, we have their debt, which segues into the risks of owning this company. As you can see, their debt has been growing pretty much non-stop since 2012, which is not what I like to see. It's at 100% of assets and multiples of their negative equity. That's right, they have negative equity because they've been taking on debt primarily to supplement their share buybacks. They've been buying back 7 to 8% of shares outstanding the past couple of years, which is great, but I don't like how they're taking on so much debt to do it. Approximately 45% of their share buybacks have been financed with debt. The rest comes from their free cash flow. I don't know about you, but I prefer that they'd reduce their buybacks to maybe 3 to 4% of shares outstanding and not take on additional debt than to continue to buy back 7 to 8% of shares. Don't get me wrong, current debt levels are manageable. According to Morningstar, they have $7.6 billion in debt maturing over the 2025 to 2029 period, but they're expected to generate more than $45 billion in free cash flow over that period. So it shouldn't be a problem, but if they continue adding on, it could become one. The other risks they face are much more impactful to the business. First, the cyclical nature of consumer spending, and more specifically, travel-related spending, can create some cyclicality in their business, but it's nothing major. Second, over the past couple of years, large tech firms like Google, Alibaba, Meta, and Amazon have been entering the travel market. In fact, Google is already having some success. These players are likely to focus their efforts on just aggregation rather than a highly focused and personalized offering like Booking is doing. But their mere presence in the OTA market creates the possibility that they will eat away at Booking's competitive advantages. But the biggest threat, in my opinion, to Booking is AI and large language models being used to push consumers directly to the provider's offerings rather than going through Booking. This can force Booking to spend even more on marketing and advertising to stay on top of customer minds, and this may not even be enough. Having said that, Booking is well underway in implementing these same functionalities into their offerings, so they should be able to hold their own. Finally, let's take a look at valuation. This is the valuation file that I manage for the 41 stocks that I track. You can get a link to the file in the description below. And with Booking currently trading at $4,573, while I estimate that they're worth $4,835, we're getting a nice 6% discount to what I estimate their intrinsic value to be based on my assumptions, which you can see right here. My base case is that they grow their free cash flow per share at 12.5% per year over the next 5 years. Compare that to the 17% that they've been able to achieve over the past 5 years, and I think it's reasonable to say that my 12.5% assumption is conservative, even after taking into account the fact that sales growth is expected to slow from 10% per year to the 7 to 8% range, and the likelihood that the rate of share buyback slows from its torrid 7 to 8% pace as well. I do use a higher free cash flow multiple than what they've been trading at over the past couple of years, but all I did was take it back to its long-term average of 20, which I feel is reasonable given the quality of the company. My bear case has free cash flow growing 10% with a 15 multiple, and my best case has it growing 15% with a 22 multiple. I put a 10% probability on both the bear and bull cases, with the remaining 80% going to my base case for a weighted average value of $4,835 per share. On the other hand, Morningstar puts their fair value at $4,600, while CFRA pegs them at $4,418. Given the fact that there are several other high-quality companies trading at much larger discounts, companies like Nvidia, Adobe, Amazon, Meta, and ASML are all trading at 30% discounts or more to what I estimate their fair value to be, while Uber, Arista Networks, Google, and Salesforce are all trading at 20% or more discounts to what I estimate their fair values to be. I just can't make the case right now to buy Booking. I'd really like to own it, but I just have so many other options trading at much larger discounts. Well, that'll do it. I'd love to hear your thoughts on Booking in the comments. Do you agree, disagree? Are you buying Booking during the sell-off? If so, please leave it in the comments. Also, please make sure to like this video and subscribe to my channel so you don't miss any of my videos when I release them. It's a quick and free way to help me grow this channel if you find this content valuable. Lastly, if you're interested in other high-quality companies that could be good buys right now, click on one of the thumbnails that you see on your screen. Until next time, you all take care. I'll see you in the next one.